Good morning, ladies and gentlemen, or good evening from anyone out in Europe or the UK. I'm joined by my colleague Luke Suddards. Welcome, Luke. How are you going?
Good, Westy. Good to be on.
Yeah. Could you just move a little bit to your right, Luke? I think just to
Yeah,
frame you
sure.
up a little bit better there. Good stuff. Yeah, good stuff. So we've got 10 minutes or 9 minutes now to the countdown of the FOMC meeting. It's a fairly monumental meeting in the sense that we've gone through the COVID situation. Obviously, still many people have experienced that, but obviously in terms of the economics and the impacts to markets where government shut economies down and then central banks had to chuck an alphabet soup of various monetary policy stimulus to get the economy fired up. And now we're at the other side in terms of where we are, and we're at a junction now where the Fed are going to start raising rates, and we're going to start seeing liquidity withdrawals in the time to come. So let's just set the scene, Luke. Obviously we've got 8 minutes now until the meeting comes. I want to take a step back at the moment. We've seen a bit of a market rally coming through. How are we seeing broad sentiment across rallies across markets? Through various asset classes here.
Yeah, we've seen a bit of a risk bid come into risk assets. We've seen some optimism while APAC was asleep. We saw a 15-point plan through peace talks, which is quite interesting. News came out on that. And then it was sort of risk assets fired up higher. And then Zelensky and Ukraine sort of pushed back on it and said, the condition of neutrality and the demilitarization, or at least some sort of limits on the military capacity of Ukraine, was unacceptable to them. And we saw risk assets sort of sell off on that as a result. But yeah, we're moving in that direction. The market seems to be taking a sort of blue sky scenario to the peace talks, and they seem to be quite happy with the early progress going on.
Yeah, good stuff. Well, I think with China's in a big one as well. The national team saying that they're going to come out and buy overseas shares, and we've seen an absolute monster rally there. I don't think we're out of the woods by any means at all, and that's what makes this Fed meeting so important. Because for me, one of the big concerns for the market is that we've had these geopolitical events, the invasion of Iran, of Ukraine. We've had massive moves in commodity prices, which has just fueled the inflation expectation situation. But all people have said, well, we've had this drawdown in financial markets, but the Fed don't have the markets back. This time is different, unlike March 2020, unlike December 2020 to 2018, and obviously the GFC. This time, because of the inflation dynamics, the market's on their own. Now, I'm not sure how well you can see this chart because your mug is over the top of the chart, but you can see here that if I move it around, you can see the blue line is the Fed funds rate. And for people who do believe that the Fed are behind the curve and really need to step it up, this is the blue line is the Fed funds rate, and you can see the white line here is US CPI. Now we know that the Fed set policy by PCE, which looks at various other factors within the basket, but you can see that the divergence is absolutely real. Now we had a period of divergence in 2011, but this is where most people say with full employment in the US and inflation really pushing up, we're going to see 5% on PCE. This is one that absolutely that they need to step in front, which is why we don't have the markets back. Let's have a look at inflation expectations, because it's not just about realized inflation, but let's have a look at break-even rates. This is the expected inflation over the coming 10 years or 5 years in the case of the purple line, and you can see forward-looking inflation expectations. They've been pushing up to record highs, effectively in break-even rates. So again, it's not just realized inflation. Survey inflation has been moving higher. Expected inflation has been moving higher. And all of these factors, which suggest that the Fed really do need to get ahead of the curve here. So a rate hike is pretty much a done deal in your eyes, right, Luke?
Yeah, 25 basis points a lock. That's going to be the key thing to watch for the market. We already know that, but I think more so important on those slides that you actually have, Westy, or if you bring those up, we can actually have a look at some of those FOMC projections there that we've got in terms of economic data and how that's going to play out. I think, the things that we know are growth's going to take a hit this year. Inflation's going to soar in the short term. But 2024 is going to be a key level. How close is that from their target at 2%? And the previous, as you've got there in that nice little orange table, 2.1%. Will it be put at that again, or will it be raised slightly higher? And the dots are obviously key to this market tonight. Market's pricing in about 7 or 8 hikes. So is the Fed. The bar is set very high. So going into this meeting, in my opinion, I'd be slightly concerned as a dollar bull. It could be a bit of buy the rumor, sell the fact kind of dynamics play out if the Fed don't.
Yeah, I think you're right. Yeah, I think you're right. This is going to be a key one for the statement, which is what we're going to be covering. We've got 4 minutes to go. The Fed funds rate, they're expected to go up from them to pencil in 0.8 or just over 3 rate hikes for the full year. I think that there's a good chance they take that to 1.40, 1.4%. But the consensus is around 1.63. With the dollar having had such a big move, certainly against the euro recently, if they take that to 1.40, penciling 5 hikes as opposed to 6, we may see a bit of weakness in dollar yen. The dollar may fall against the euro and the pound, and gold may have a little bit of a move. But that's going to be very initially, because then we go out further on the curve. Do they take that Fed funds rate to 2.63, or is that lower? And then really it's about that 2024 level. So I think the market's going to be quite sensitive to that. That we are going to see some chunky upgrades to core PCE, the inflation number. Inflation's obviously been rife. It's become quite political. So I think in terms of the checklist, Luke, what we're looking for in this statement, I think they'll hike by 25 basis points. Then we look out further out the curve. If I bring up this chart here, this is just on my Bloomberg charts. So you can see here, this is where the current dot plot projections are, but you can see that the market, this purple line, is saying that they've got rates priced at 1.95% for 2022, and 2.34 for 2023, and then that comes down to 2.11 in. So look, even if they raise these rates, their expectations up to where they think they are, the market's already well above that level anyway. So that in theory suggests we can be a little bit. There are some downside risks to the dollar. Positioning in the dollar is quite, I'd say, rich, but we've always got to look at that. If you look at Commitment of Traders report, that people are running dollar longs into this meeting, and optionality is been quite strong. The dollar's been a good geopolitical hedge against what we've been seeing as well. So you say that. What else? What other factors are you going to be looking for in this meeting?
Yeah, I think QT is another one that's a bit of an unknown.
Just for people who don't know what quantitative tightening is, do you want to just quickly explain what it is?
QT, quantitative tightening, so the opposite of quantitative easing. Instead of buying bonds, they're going to start to shrink their balance sheet down, reduce it. Now, we may get some color on that, maybe the levels that they might cap monthly runoffs at. It could be 60-40 split between treasuries and mortgage-backed securities, so a total of 100 bill a month. And either we'll get maybe some more color on that tonight at tonight's meeting, or we'll see it push back to May and a potential start date for June. We're coming up quite close now, about a minute away on my clocks here from the actual event, and Westy's got the nice set up, the split screens to show us the market reaction.
I just want to say as well, to cut you off, apologies. I think they'll raise rates here, but I think given everything that's going on in geopolitics, and we'll search out what they have to say here, but the fact that the bond market's pricing in 7 rate hikes for this year is one thing. The second thing is I think they're going to be very vague in their outlook and say that we could raise 50 basis points at an upcoming meeting, we could raise 25, or we could leave rates on hold. It really is data dependent and depending on their outlook. But very much. Look, we've seen the market rally here. So we're seeing dollars moving up. Yeah, we've seen dollar moving. I know this is a 1 minute chart, so it sort of exasperates what we've been seeing.
So the Fed's hiked by 25 basis points. Locked, as we said. Yeah. Let's see what else is coming through.
Okay. I'm just trying to get what the have you got the statement up there, Luke?
I'm pulling it up right now. The site was obviously getting a lot of traffic, so it was a bit slow. I'm pulling it up as we speak.
Okay, so we're seeing the Fed forecast the funds rate at 2.8% for 2024. Now that straight away is significant. The market was looking for 2.6, so they've gone for 2.8%. They see inflation at 4.3 for 2022. I'm just getting this off from Bloomberg. So that's 50 basis points above where the market was looking for. That's a big move. They've increased the discount rate by 50 basis points as well. I'm not sure if that really come onto anyone's kind of radar as well. So I'm just looking at the projections here that we're seeing. They've got inflation at 4%. So the inflation for 2023 is way higher than what the market was looking for. 2.7% for 2023 for next year. Again, that's that's quite a big move there as well.
Yeah, that's 7 hikes. That's 7 hikes priced in this year's dot. Very interesting, and 2.8% at the end 24.
Have you got the numbers there? Do you want to read them out?
Yeah, I'm just going through it now through Twitter. The Fed forecast rates about 2.8% in 24, and the long run cut to 2.4%, their terminal. So they're taking rates restrictive, essentially above that neutral rate. I'm just trying to see statements loading up.
Okay, so we saw initially dollar move up to on dollar yen 118.58 up to 83. So that obviously just in line with what we saw for the slightly more hawkish statement. Yeah, look, I can't even get the Fed website up at the moment. There's just so much traffic going to it.
Sorry, Westy. I can't. It's just not coming through. I think there's just tons of traffic on it at the moment, unfortunately. Everybody is trying to access it.
So they've got the dot plot now for 2024 at 2.75%. I'm just getting headlines coming through. So that's an overshoot of the neutral rate by about 25 basis points. So that's pretty hawkish. Yeah, the market was looking for that to be around 2.6%. So again, just another little situation that we're looking for. They've got the unemployment rate dropping to 3.5% by the end of this year. I think that was pretty much expected. I don't think there's anything to see there. I think that shift in the long run policy rate is certainly quite interesting there.
I've managed to get up the economic projections, West, if you want me to just run through a couple of the inflation numbers. So I've got some core PCE numbers here. 2024, it's been revised up from December for 2024 from 2.1% to 2.3%. This year got a real chunky upgrade from 2.7% to 4.1%. And next year, 2023, it's 2.6%. So yeah, a little bit higher above their target of 2%. Unemployment sort of leveling off, staying the same, no shocks there. GDP's got a big knockdown this year, big downgrade, right down to 2.8% from 4% in the December projection, and then it sort of degrades down to 2%, and 2.2 in 2023, which is in line with estimates. But yeah, 2024 2.8% on the Fed funds dot, and that's above, as Westy's alluded to, their neutral rate of 2.4%.
Do you want to just read? Sorry, do you want to just read out those the Fed funds numbers again?
Yeah, so 1.9% for 2022, 2.8% for 2023, and 2.8% for 2024, and then 2.4% their longer run terminal neutral rate. So yeah, big upgrades across those years and from the December projections.
Okay, cool. So what we're seeing here, let's go through the chart. So we've immediately seen 2-year Treasury showing everything you need to know. So the 2-year Treasury's jumped up from 188 to 198. So the market's clearly taken that as a hawkish shift that we've been seeing. Let's go and have a look at the 10-year Treasury.
I think the yield curve's taking a big hit here. It's flattening
So
quite
we're seeing
aggressively.
10s move up to 220. So this obviously is a decent move that we've been seeing across the bond market that was played through. Let's have a look at the interest rate markets and see how they're trading. So okay, so we're seeing selling across the curve. If I go out to the end of the year, we can see that we can go into December, we've got that up 6 basis points. So the market's pricing another 6 basis points of hikes by the end of the year. So that's obviously somewhat more hawkish. We can go and let's have a look at swaps and see how many hikes are now being priced in by the end of the year. Okay, so we've had one rate hike. We've still got another 6 hikes being priced into by the end of the year. 6.6 hikes being priced into the year. Let's have a look at the dollar reaction that we're seeing on the floors. I'd imagine dollar yen would be the place to look.
Yeah, dollar yen is surging
okay, so there we
higher.
go. Yeah, so as those moves in front end yields have moved up, we've seen dollar yen move from 60 up to 88. So not a massive move by any means in dollar yen. Let's have a look at gold and see how that's sort of fared. We've got a nice move in the treasury market. That's where the action seems to be taking place, and that should, in theory, be very dollar positive. If you have a look at gold, it hasn't really done a huge amount. We've sort of traded down into 1904. We traded back up to 1916. So $12 range on the back of that. I want to have a look at see if Bloomberg have upgraded their dots.
No, they haven't yet.
No. Oh well. Let's have a look at S&P futures. Let's see how they've reacted to this statement. A little bit of selling, as you'd imagine. The dollar's moved up a little bit higher on the back of what we've been seeing. Treasuries have been offered, and we've seen the dollar moving from 1917 down through the figure 42.93. So obviously a little bit of hawkish situation that's been playing through. Typically, we do see the S&P rally into that last sort of 8 out of the last 10 meetings. We've seen the market rally there. Peter writes a really good question there. Do you think this might be already priced in? Absolutely. I think there's so much being priced into what we've been seeing there. I just need to see these dot plot projections. I just can't get a link for it. Do you want to just slack me that?
Yeah, I was just thinking of doing that, Westy. I can send that over to you.
Okay, so this is quite an interesting one. We're still getting some colour around the QT meetings. The Fed will start reducing its asset purchase at the coming meetings. Now that is definitely priced in. I mean, the market is expecting the Fed to start asset QT in the June meeting. It should be formally announced in the May meeting. And we should probably start seeing that enacting. At least the consensus is they should start seeing that coming through with caps on the maturing bonds that come through probably in the June meeting as well. I need to get these dot plot projections. Where are they?
I've slacked them to you, West. You should have them in your Slack. Unless you want the actual dots, I've just given you the summary, so you've got the actual numbers. Yeah.
Okay, so look, I think, look, what's a good way to look at this? I think probably the best way to look at this now is I'm going to go and show you the Fed funds future, right? So the Fed have said that the Fed fund median projection is 1.9% for December, 2.8%, and these were higher than the market was than the consensus was expecting. So this is bullish. This is why the dollars. Yeah, I'm using a Bloomberg terminal, guys. So what you can see here is that the market. So what we've seen effectively is the Fed have raised their estimates to 1.9%. So that effectively gives you, if you divide that by 25, the Fed have basically penciled in nearly 8 rate hikes for this year. So we've obviously just had one. We're going to expect, another 7 rate hikes this year. So that effectively means that the Fed are going to be looking to raise rates at every single meeting going forward. They said that the Fed funds rate for next year, 2.8%. The market was looking for an optimistic base of 2.6. So again, because they've raised what we've been seeing in the front end, that they've obviously moved that concurrently up in 2023. The 2024 number at 2.8% is better, higher than the market was looking for. So from the dot plot projections, how much can we read into that? That was higher or more hawkish than what economists were expecting. Now the question is was it more hawkish than what the market's expecting? There's a couple of people making a good point that it was probably priced in. We'll have a look now. December Fed funds are priced at 189. So, effectively the Fed funds market, this is the interest rate market that you can bet on effectively of where interest rates are going to be. They're pretty much bang on where the Fed are projecting, right? So is it priced in? It is priced in now because you can see this December number, and I'm using a Bloomberg terminal, is pretty much bang on where the Fed funds are projecting. So that's a really nice mix. The Fed and the market are pretty much on the same page, and you can see here there's been a material shift in interest rate pricing. You can see that December has gone up by 16 basis points, so that's a huge move in terms of what we're seeing in the rates market, and because of what we've been seeing there. The inflation numbers, I was